Welcome back, everyone, to the deep dive. Forget the passport, but keep your focus across the Atlantic because, wow, some huge news dropping from the UK. Market-moving stuff.
Really big news, yeah. Hard to overstate this one.
The United Kingdom, one of the world's enduring financial powerhouses, has officially reversed its long-standing ban on Bitcoin and Ethereum exchange-traded notes, ETNs, that is.
That's right, a major policy shift.
And critically, this opening is specifically for professional investors, right?
Mm-hmm.
Not for everyone just yet.
Exactly. That's the key distinction for now. Only the pros.
This marks the first time since, what was it, January 2021? That's a massive 3-year regulatory freeze.
A long time in the crypto world. Feels like an eternity.
That institutional players in the UK can legally gain regulated exposure to the two biggest digital assets. We aren't just talking about some minor update here, are we?
No, absolutely not. This is London officially re-entering the global crypto finance race in a big way.
So our mission today is pretty clear. We need to break down what these ETNs actually are, structurally, and crucially, try to understand why the Financial Conduct Authority, the FCA, decided to reverse this ban now. What changed?
Right. The timing is key.
We'll dig into the immediate impact on global Bitcoin momentum, what this means for price and adoption, and explore what this whole regulatory thaw signals for the future of finance, maybe across Europe too.
And what's truly fascinating here, as you said, is just the sheer magnitude of this policy shift. It's not just tweaking some compliance rule.
Definitely not.
This is a very deliberate, you could say calculated move.
Mm-hmm.
It's a regulatory green light, essentially, that immediately reopens the door for London-based asset managers.
Mm-hmm.
And we're talking about firms managing trillions of pounds collectively.
Trillions, yeah.
They can now actually launch crypto-backed products again, legally, within a regulated framework.
Mm.
And you really have to view this through a competitive lens. The context is absolutely everything here. Think about it. The U.S. spot Bitcoin ETFs, they've been running since January, right? Setting just unprecedented records for institutional inflows.
Billions upon billions.
Tens of billions, yeah. Meanwhile, you've got Hong Kong successfully launching its own crypto funds, cementing itself as the kind of digital finance gateway for Asia.
Right.
So the UK, historically this leader in global finance, has basically been sitting on the sidelines watching all this capital, all this activity flow into New York and Hong Kong.
Feeling left out, essentially.
You could definitely say that.
Yeah.
This reversal is London stepping back into the ring. It signals an institutional normalization that's, frankly, essential for its own financial recovery and, future relevance, especially post-Brexit. They're mirroring what's already proven successful globally.
Yeah.
That makes this a pretty profound political and financial statement.
Okay, before we get deeper into that whole geopolitical chess game and the FOMO aspect, we absolutely have to clarify the technical instrument here. Because we hear ETF exchange-traded fund all the time now. It's everywhere.
Constantly.
But this UK decision involves an ETN, an exchange-traded note. They sound so similar, but the structure, the risk profile, it's fundamentally different, isn't it? And that difference is why the FCA was so cautious initially.
Exactly. That's the essential starting point. You absolutely have to understand the structure because the risk is baked right into it.
So can you define an ETN for us and really hammer home that crucial difference compared to, say, a spot Bitcoin ETF like we see in the U.S.?
Sure. So an ETN, or exchange-traded note, is indeed an investment product. It trades on an exchange, just like a stock or an ETF. So it gives investors that easy access, that liquidity they like.
Familiar feel.
Right. But, and this is the big but, the core identity of an ETN is distinct. It's structured as an unsecured debt security. Think of it like an IOU. It's essentially a promise, issued by a big financial institution, usually a large investment bank, or maybe a brokerage firm. And the crucial distinction, the thing that really worried the FCA back in 2021, relates to, asset segregation and counterparty exposure. Unlike an exchange-traded fund, specifically a spot ETF.
Like the U.S. ones.
Precisely. Those spot ETFs are designed to actually hold the underlying asset. Physical gold in a vault, or actual segregated Bitcoin held securely, usually by a third-party custodian, in trust for the investors.
Okay.
ETNs do not hold the underlying asset directly. That's the key takeaway. They are merely contractual obligations from the issuer. They track the performance of Bitcoin or Ethereum, sure, but the investors essentially rely entirely on the creditworthiness of the issuing institution to make good on that promise.
Okay, let me see if I've got this straight. If I buy a share of a spot Bitcoin ETF, I theoretically own a tiny slice of actual Bitcoin being held somewhere safe, off the issuer's books.
Broadly speaking, yes.
Yeah.
That's the principle.
But if I buy an ETN share, I'm essentially just lending money to, say, Big Bank PLC. And that bank promises to pay me back based on how Bitcoin performs.
That's a very good way to put it. You're buying their debt.
Which means I've got two distinct risks running simultaneously, correct? There's the price risk of Bitcoin itself. It could go up or down.
Standard market risk.
But then there's also the credit risk of Big Bank PLC. What if they get into trouble?
Precisely. That dual exposure is what makes ETNs different and, frankly, justifies the FCA's very selective approach here, limiting it to professionals.
Yeah.
With a spot ETF, because the asset is usually held off the issuer's balance sheet by a separate regulated custodian, if the ETF issuer goes bankrupt, the underlying Bitcoin is theoretically protected. It's segregated.
Right.
With an ETN, however, because it's structured as a debt liability on the issuer's own balance sheet, if that institution defaults, and we've certainly seen massive financial institutions fail in past crises, think Lehman Brothers.
Of course. 2008.
Then the ETN investor becomes just another unsecured creditor. You're standing in line with all the other people the bank owes money to, trying to maybe reclaim some losses. It's a fundamentally different and potentially higher risk profile. That's why this instrument is generally considered suitable only for sophisticated professional entities, the ones with big risk analysis teams and the capital to absorb potential losses.
Wow. Okay. That structural reality immediately clarifies the whole history of the ban, doesn't it? The FCA wasn't just worried about Bitcoin being volatile back in 2021.
No, it was deeper than that.
They were fundamentally worried about, everyday retail investors unknowingly signing up for corporate debt risk, layered right on top of crypto's inherent volatility, without fully grasping that counterparty danger.
That's exactly it. You hit the nail on the head.
Can you just remind us quickly of how protective, how restrictive that stance was back then?
Oh, the FCA's position was crystal clear and very firm. They outright banned the sale, marketing, and distribution of all crypto ETNs and derivatives to retail consumers in January 2021. Full stop.
Right when things were getting wild.
Exactly. This was as the crypto markets were entering one of those periods of extreme headline-grabbing volatility. The regulators, looking at this, felt these complex, debt-structured products tracking highly volatile assets posed an unacceptable level of risk to ordinary consumers. You could call it a paternalistic move, maybe, but it was clearly driven by a desire to prevent widespread financial harm.
Understandable given the context.
And you also had at the time a real lack of regulated custody solutions, plus the prevalence of high leverage being used by retail traders. The whole ecosystem just felt highly unstable from a regulatory perspective, so they put the brakes on hard. But that stance, however protective its intentions, completely froze UK financial institutions out of participating in the regulated digital asset market for 3 years.
So the million-pound question then, what actually changed in those 3 years to make the FCA do this U-turn, even if it's just for professionals for now? Market stability alone feels, well, insufficient given crypto's nature. It's still volatile.
It is, and you're right, it's multifaceted.
Yeah.
But I think the key word here is normalization. The FCA's rationale for reversing the ban now seems to rest on two main pillars.
Okay.
First, yes, they do argue, perhaps optimistically, that the markets have stabilized somewhat and definitely matured. You have major traditional institutions involved, now custodians, market makers, data providers, which generally imposes a higher standard of conduct of market surveillance compared to 2021.
Right, the infrastructure is better.
Definitely. Second, and perhaps even more crucially, global regulatory clarity has improved immensely. That's undeniable. We've seen major economies, most notably the U.S. with its approval of the spot ETF structure, and the entire European Union with the implementation of its comprehensive MiCA framework.
The Markets and Crypto Assets Regulation.
Exactly. MiCA created robust, standardized guidelines for digital assets and service providers across 27 countries. This global regulatory convergence gives the FCA, and other regulators, frankly, more confidence that sufficient guardrails are now in place or can be put in place, provided they control who gets access initially. So this reversal, being restricted only to professional investors, we're talking hedge funds, pension funds, family offices, the sophisticated players, it signals that the regulator is acknowledging the maturity of the institutional infrastructure around crypto. They're basically assuming these professionals have the required expertise to properly assess that counterparty risk we talked about.
And the capital to handle swings.
Exactly. The capital buffers to withstand market movements, and importantly, the sophisticated compliance frameworks needed to manage the risks associated with holding a debt security liability correctly.
So the immediate relevance isn't just about, money potentially flowing into Bitcoin and Ethereum via London. It's much more about legitimization. It's signaling to the entire financial world that London now accepts these digital assets as maybe not mainstream yet, but as a legitimate portfolio tool for serious players.
I think that's a huge part of it.
That institutional normalization, especially coming from a regulator like the FCA, feels like a massive psychological step forward, particularly after major market disruptions like the collapse of FTX, which, let's be honest, severely damaged public trust across the board.
Absolutely. In traditional finance, the regulator, the big banks, the exchanges, they are the ultimate arbiters of legitimacy. When a globally respected regulator like the SCA approves a product structure, even if it's initially restricted, it sends a powerful validation signal about the underlying asset class itself globally. It's like a seal of approval, almost. Essentially, yes. It tells the financial world, okay, Bitcoin and Ethereum are now considered mature enough, stable enough for our most sophisticated class of investors to handle them, provided it's done within these strictly regulated parameters. That regulatory foundation is precisely what institutions need to justify allocating potentially massive amounts of capital. It gives them the compliance cover they require.
Okay, let's pivot then to those wider political and competitive dynamics. Because, as you said earlier, this decision definitely didn't happen in a vacuum. You mentioned the US and Hong Kong already forging ahead.
They set the pace.
I think it's fair to say the UK probably had a severe case of global financial FOMO, fear of missing out. This seems tightly linked to its highly publicized desire to sort of reinvent itself or at least reestablish its position on the global financial stage, especially post-Brexit. But is this move purely defensive, just catching up, or is there maybe a more proactive leading strategy hidden in here?
That is the really interesting question, isn't it? And the answer is probably a bit of both. If you look at the political imperatives, there's no doubt the UK's financial identity has been under intense pressure since leaving the EU.
Definitely. Lots of talk about losing ground.
Right. And there has been a very clear, focused effort across government Whitehall, the Treasury, to reestablish London as a leading, future-proof global fintech hub. You hear that phrase, sometimes optimistically, sometimes maybe cynically, Singapore on Thames.
Yep, heard that one.
To achieve that ambition, they have to be seen as aggressive and forward-thinking in high-growth areas.
Oh.
And given that the regulated digital asset market is arguably the fastest-growing segment of institutional finance right now, well, they simply could not afford to be excluded any longer. Sitting on the sidelines wasn't a viable option if they want to be that hub.
The competitive landscape just forced their hand, essentially.
It really did. The U.S. approving its spot Bitcoin ETFs back in January 2024 was the absolute watershed moment. It demonstrated undeniable, massive institutional appetite. Billions flowed in almost immediately.
Changed the game overnight.
It did. And that was followed very rapidly by Hong Kong launching its own spot Bitcoin and Ethereum funds in April 2024. So now you had this dual threat emerging. New York capturing the lion's share of Western institutional capital, and Hong Kong positioning itself to corner the huge Asia-Pacific market. London was conspicuously absent from both pictures.
Okay, so hearing that, it really does sound mostly defensive then, doesn't it? Isn't London just confirming that it kind of lost that initial race to New York for the prime spot product structure, and now it's just playing catch-up rather than genuinely leading with some new innovation?
That's a highly critical read, but yes, it's a fair assessment in many ways. They certainly ceded the leadership position in developing and approving the spot product structure to the US SEC, no question there.
So why ETNs then? Why not push for spot ETFs too?
Well, the move seems less about trying to reclaim leadership now and more about immediate viability and speed to market. By adopting the ETN structure, the UK is leveraging an instrument that's already quite familiar and established, particularly in continental Europe. Places like Switzerland and Germany have had crypto ETNs for years.
Ah, okay, so it's faster to implement.
Potentially, yes. It's often quicker to launch an ETN framework, which relies on existing debt issuance rules, than it is to build out a whole new complex spot ETF framework that requires really intricate rules around physical custody, segregation, audits, and so on. That takes time. The ETN route allows them to align Britain much more quickly with the existing international digital asset investment wave. They're essentially saying, okay, maybe we missed the absolute first wave with the spot product, but we will absolutely not miss the institutional money that is clearly ready to follow now. This decision sends an unmistakable message to all the global financial giants. Crypto, specifically Bitcoin and Ethereum, is now officially too big to ignore, and London wants to be the place that facilitates that regulated investment stream into Europe. They're positioning themselves as the continent's primary regulated digital finance gateway.
And we have solid proof this isn't just regulatory lip service, right? The operational gears are already turning very rapidly. That suggests the whole financial infrastructure, the LSE, the issuers, they were basically waiting, holding their breath for this green light.
Oh, they are moving at warp speed. It's quite remarkable. The London Stock Exchange, the LSE, has already granted approval for the actual listing of Bitcoin and Ethereum ETNs.
Already approved. Wow.
Yes. And the expectation, based on the sources, is that these products will go live on the exchange within this current quarter.
So potentially weeks away?
Potentially. This rapid acceleration clearly indicates that the key players, the Treasury, the FCA, the LSE, they all coordinated this reversal behind the scenes. They knew that any significant delay would mean losing potential institutional mandates, losing capital flows to competitors in New York or Frankfurt or Zurich. Speed was essential. And furthermore, as you mentioned, the key issuers are already mobilized and ready to go. We're talking about major established names here, like WisdomTree and 21 Shares.
Familiar names in the European crypto ETP space.
Exactly. These firms aren't newcomers, they are pioneers. They've successfully launched and managed crypto ETNs across Europe, particularly in Switzerland and Germany, for years. They've navigated complex European regulations already.
So they have the playbook.
They have the playbook, they have the infrastructure, they likely have the products pretty much ready to go. Their immediate readiness strongly suggests they were actively consulting with, maybe even lobbying, the FCA for this change for some time. And they probably have these products basically sitting on the shelf, ready to deploy capital the moment the gates officially open. That level of institutional readiness suggests this won't be a slow trickle of adoption. It seems set up to be an immediate and potentially significant influx of new regulated products hitting the London market. Okay, so let's really drill down into the so what for the actual financial players involved. The immediate market impact, I think, is best understood as a seismic shift in institutional confidence and, maybe more importantly, portfolio construction credibility.
Right. How does it change things for them day to day?
Well, historically, many major players think pension fund managers, sovereign wealth funds, even large hedge funds and family offices, they were effectively constrained. Even if they personally believed in the investment thesis for Bitcoin or Ethereum, their own internal compliance rules, their mandates, often prevented them from directly interacting with unregulated crypto exchanges or from holding the physical assets directly due to custody complexities and risks.
Too much career risk, basically.
Exactly. Too much career risk, too much compliance headache. Now suddenly they can gain exposure safely, or at least within a regulated framework, and efficiently through these ETNs, trading on a highly trusted established exchange like the LSE. That's a game changer for a compliance department.
So it ticks the regulatory box.
It ticks the regulatory box. And for professional portfolio managers, this fundamentally changes Bitcoin's potential role within their overall strategy. It shifts it away from being this purely speculative, highly volatile asset that maybe you manage in a tiny separate alternatives bucket, if at all.
Towards being potentially an official, creditable portfolio asset, something you can allocate to systematically across potentially billions in assets under management, AUM.
Precisely. And the narrative they use to justify this internally often revolves around Bitcoin as a necessary portfolio tool, increasingly viewed as a kind of digital reserve asset, offering a potential hedge against persistent inflation, against the effects of quantitative easing by central banks, and maybe against broader monetary instability or geopolitical risk. It gives them a new non-correlated asset to consider.
Okay, that makes sense from the portfolio manager's view. But let's get into the market mechanics. We know these ETNs track the price, but you clarified they don't hold the asset directly like a spot ETF. So how does trading a debt note actually drive demand for the underlying Bitcoin and Ethereum? Does it still translate into real buying pressure on the actual crypto markets?
Yes, it absolutely still drives demand, although the mechanism is slightly different, and maybe a bit more technical than with a spot ETF. It's not quite as direct, but the end result is similar.
How does that work then?
Okay, so for a spot ETF, it's simple. The issuer must go out and buy the physical asset, actual Bitcoin, and hold it in custody for pretty much every new share of the ETF that gets created. That's direct buying pressure.
Right, one-to-one backing.
Exactly. For an ETN, remember, the issuer doesn't hold the asset for the investor directly because it's a debt note, an IOU. However, the issuer still must hedge their own liability. They've made a promise to pay the investor the return of Bitcoin.
Okay. They're on the hook for the performance.
They are completely on the hook.
Yeah.
So to manage their own balance sheet, risk their obligation to pay the return of the tracked asset, the issuing institution must constantly delta hedge its position. This typically requires them to go into the market and purchase either the underlying Bitcoin and Ethereum directly or perhaps highly correlated derivatives like futures contracts.
To offset their promise.
Precisely. This ensures that their debt liability, what they owe the ETN holder, is matched by a corresponding asset exposure on their own books. So, as institutional money flows into these new UK ETNs, the issuance of new ETN notes increases. This, in turn, forces the issuer to buy more Bitcoin or Ethereum or related hedges to maintain their neutral risk position. And that buying activity ultimately drives up demand and increases overall liquidity for Bitcoin and Ethereum, specifically within the regulated market sphere.
Okay, so maybe not direct one-to-one buying like a spot ETF, but still a significant mechanism-driven buying pressure as assets flow in. And increased liquidity is always key, isn't it? Because that generally leads to greater price stability over time. And given the sheer scale of capital potentially available in London, maybe significant upward price pressure too.
That's certainly the anticipated outcome, and frankly, it's the proven outcome based on recent history. We don't really have to theorize too much about what happens when institutions gain large-scale regulated access to these assets. We have a very clear, very recent precedent.
The US ETFs.
It's exactly. Just look at the impact of the U.S. spot Bitcoin ETF approval in January 2024. That single regulatory move unlocked a torrent of capital, triggering over $25 billion in net inflows within just a few months. It effectively doubled institutional participation almost overnight and dramatically professionalized the entire Bitcoin trading landscape. Price discovery became much more influenced by institutional flows during U.S. market hours. And the UK market is, well, it's huge. Different structure with the ETN, as we've discussed. The credit risk is there. Yeah. But the sheer volume of funds managed out of London that could potentially allocate is vast. It's enormous. So the expectation is therefore quite clear. We are very likely to see a rapid renewed wave of institutional accumulation, this time originating from the UK market, potentially mirroring some of the scale and speed we saw with the US launch earlier this year. Think about UK pension funds, for example. They manage truly staggering amounts of retirement capital. If they now have a compliant path to allocate even a tiny fraction, say 0.1% or 0.5% of their capital to digital assets via these ETNs,
that alone constitutes a massive new source of demand. And it's synchronized with the U.S. flows, the Hong Kong flows.
Exactly. It becomes a new, significant source of synchronized global capital flowing into the asset class through regulated channels.
And crucially, we should reiterate, this isn't just a Bitcoin story, is it? The outline stressed that Ethereum is benefiting immensely here too, kind of riding shotgun on this institutional wave.
Indeed. Ethereum benefits significantly because it offers diversification within the nascent digital asset class itself. Institutional investors, especially the more forward-looking ones, aren't just looking for Bitcoin purely as a digital gold or store of value. Many are also looking for exposure to the broader digital economy or Web3 thesis.
The platform layer.
Right. And Ethereum being viewed as the primary utility blockchain, the foundational layer for DeFi, NFT, smart contracts. It's the natural secondary asset to include alongside Bitcoin in any diversified institutional crypto allocation. The source material specifically highlights that many of the planned ETN structures in the UK are expected to include exposure baskets featuring both assets. And this dual legitimacy is really important. It reinforces the narrative that these two specific assets, Bitcoin and Ethereum, have now achieved a level of regulatory comfort and institutional acceptance that significantly separates them, at least for now, from the vast majority of the altcoin market in the eyes of traditional finance.
Okay, so currently this is strictly an institutional party, professionals only. But this is obviously the burning question for pretty much everyone else in the UK interested in crypto. Is retail inclusion inevitable? If the big institutional gates are now open, how long, realistically, until the everyday UK investor can just log into their brokerage account and buy these same ETNs?
Yeah, that's the question on everyone's lips, isn't it? The general consensus across the industry, and hinted at by regulators, seems to be that retail inclusion is highly probable, maybe even inevitable. But it will absolutely be on the regulator's own cautious terms and timeline.
They'll want to see how this first phase goes.
Exactly. Once this professional market proves itself, proves to be secure, stable, transparent, well-managed under this new framework, the FCA is going to face massive political and market pressure to loosen those constraints for retail investors. They're essentially using the professional market as a controlled test environment right now.
Makes sense. Any indication on how long that test phase might last? Are we talking years?
Well, surprisingly, the source material we looked at was actually quite specific on a potential timeline. It projected that the FCA may consider loosening restrictions for retail within about 12 to 18 months.
12 to 18 months. That's actually quite soon in regulatory terms.
It is very tight. That suggests the FCA probably knows it can't hold the line against widespread public demand indefinitely, especially if these institutional products are performing well, trading smoothly, and operating without major issues within a regulated environment on the LSE. Public pressure, combined with industry lobbying, will likely be intense if the institutional launch goes well.
Okay, that's fascinating. And it tracks perfectly with all the growing industry research we're seeing about the general global surge in retail interest in crypto. Regardless of specific ETN access in the UK, there seems to be a broader wave building.
Exactly right. There was a recent industry report projecting that the global retail crypto market, everyday people investing, could expand by a substantial 40% within just the next 2 years. 40%.
Wow, what's driving that specifically?
Well, this growth isn't just speculative hope. The report argues it's driven by several compounding factors, and the UK's move kind of pours fuel on that fire. Let's list the three main fueling factors they identified. First, and obviously relevant here, is easier, more familiar, and importantly, regulated access to crypto investment products, things like ETNs and ETFs. This drastically lowers the barrier to entry compared to using, say, an offshore crypto exchange, which can feel complex or risky for newcomers.
Right, buying it like a stock.
Makes it feel safer and simpler. Second is the increasing real-world adoption of crypto for payments and services, often integrated via ubiquitous platforms people already use and trust. Think PayPal, Revolut, maybe even features integrated directly into traditional banking apps. This makes crypto feel less like some exotic, speculative thing and more like a usable part of the digital economy.
Normalization through utility.
Exactly. And third, and perhaps the most critical psychological factor, is the institutional normalization that we've been discussing throughout this deep dive. That validation from big regulated players dramatically helps public trust recover, especially after the reputational damage from high-profile failures like FTX or Celsius. When large regulated institutions are publicly involved, the average person just feels inherently safer dipping their toes in.
So even while UK retail investors are explicitly excluded from buying these new ETNs right now, the very fact that institutions can buy them creates these sort of indirect compliant channels for retail exposure down the line, and it just generally drives the whole narrative of legitimacy and utility forward.
Absolutely. You can expect the UK retail investor base to see a surge in institutional access, probably via several indirect means initially. This could include things like crypto savings accounts offered by regulated neobanks, perhaps more tokenized funds becoming available, and then eventually likely direct access to these ETNs or maybe similar slightly tweaked products designed with more consumer protections under a revised regulatory framework. The institutional acceptance effectively paves the regulatory, the custodial, and the technical groundwork for the retail infrastructure to inevitably follow.
Okay, stepping back out from just the UK for a moment. This decision, London re-entering the fray, must have significant ripple effects across the continent, right? What's the European momentum looking like, especially given that the UK is now acting independently of the EU?
Oh, the sentiment across Europe seems to be hugely positive, or at least highly attentive. While the UK is, of course, no longer an EU member, London's financial decisions still carry enormous weight and tend to set precedents, particularly in finance.
Still a major gravity well for capital.
Absolutely. So the UK's move could very well act as a catalyst, immediately sparking neighboring markets, specifically of major financial centers like Germany, France, maybe the Netherlands, to either aggressively expand their own existing crypto investment vehicles, which in Europe, as we noted, are often already ETN structures.
Or perhaps accelerate the introduction of similar newly regulated products to compete directly with London. No major European financial center wants to just sit back and lose institutional activity, lose trading volume, lose capital flows to London without putting up a fight.
Precisely. It ramps up the competitive pressure across the continent. And this action also ties in very directly, I think, to the influence of the EU's own landmark MiCA regulation, the Markets in Crypto Assets framework, which is going to fully live across the block this year, 2024.
Right, that huge piece of legislation.
MiCA provides a comprehensive, standardized, and quite rigorous regulatory framework for crypto assets and service providers across all 27 EU member states. Now, while the UK is obviously independent and not bound by MiCA, the very existence of MiCA has fundamentally standardized the sector across Europe. It provided a common template for things like governance, consumer protection, operational resilience, capital requirements. It undoubtedly influenced the FCA's thinking, giving them confidence and perhaps a model for timing their own policy shift. Global regulatory certainty definitely breeds local action.
So if we pull back to the really macro picture, this suggests the UK isn't just playing catch up to the US anymore. It seems like it's consciously adopting a proven global playbook, using the Hong Kong launch as a more direct model perhaps, to try and establish itself as the premier European crypto finance hub.
I think that's a very accurate, high-level synthesis. This move absolutely reinforces that global crypto legitimacy narrative we talked about. It's rapidly accelerating the convergence between traditional regulated finance and the world of blockchain and digital assets. And the direct comparison is Hong Kong.
Why Hong Kong specifically?
Because Hong Kong also approved both Bitcoin and Ethereum products, spot ETFs in their case, simultaneously, aiming to capture broad digital asset interest, not just Bitcoin. And their launch back in April 2024, while maybe not quite hitting the astronomical numbers of the U.S. launch, still generated significant inflows over $500 million in the first week alone, which is substantial for that market. That's kind of immediate impact and positioning, becoming the regulated gateway for a whole region that the UK seems to be mirroring. London is clearly trying to establish itself as the European equivalent of New York's sophisticated, institutionally focused crypto finance hub. And looking ahead, we can probably confidently forecast what some of the sources were referring to as a kind of global ETF-ETN arbitrage cycle emerging.
What do you mean by that?
Well, when the U.S. ETFs generate massive demand during their trading hours, and then Hong Kong funds capture Asian wealth during their session, and now UK ETNs open up European institutional capital during London hours, you get these potentially synchronized, regulated inflows happening across major global markets, almost around the clock.
A continuous flow.
A continuous self-reinforcing flow of institutional capital entering the market through regulated pipes. This dynamic, if it plays out, should theoretically contribute to greater price stability over the long run, reduce arbitrage opportunities between regions, and further solidify institutional acceptance worldwide as liquidity deepens globally.
Okay, we've established pretty clearly that this is overwhelmingly seen as bullish for institutional access, for market structure, for legitimacy, but, a proper deep dive requires that balanced perspective. The fundamental reasons the FCA banned these products back in 2021, specifically the volatility concerns and the structural risks, they haven't entirely vanished, have they?
No, not at all.
So when we dive back into that ETN structure itself, that primary issue, we discussed the fact that it's basically a debt liability of the issuer that remains. We really have to critically emphasize that issuer risk, don't we?
Yes, absolutely. This is, without doubt, the most crucial caveat, the biggest asterisk next to this news. Any professional investor considering using these new UK ETNs must have this distinction. The counterparty risk absolutely top of mind. It cannot be overlooked.
So spell it out again clearly.
Because ETNs are fundamentally credit-based products, they are essentially unsecured debt notes issued by a bank or other financial institution. Investors are inherently exposed to issuer risk, sometimes called counterparty credit risk. And to put an even finer point on it, if the financial institution that issued the ETN were to face severe financial distress, maybe become insolvent, or even go into outright bankruptcy, well, the ETN holder is relying almost entirely on that issuer's general creditworthiness.
You're just another creditor.
You are just another unsecured creditor. Historically, we have definitely seen major, seemingly stable institutions that issued similar types of structured debt-backed securities default. The most famous example, of course, is the collapse of Lehman Brothers back in 2008.
Right. Sent shockwaves everywhere.
It did. And holders of some specific structured products, including certain types of notes issued by Lehman, found themselves holding paper that became effectively worthless when the counterparty failed. This is a systemic risk that exists entirely outside of Bitcoin's own price performance.
So you could be right about Bitcoin's price going up, but still lose your investment if the ETN issuer goes bust.
Precisely. It means institutions using these products have to perform serious due diligence. They need to assess the crypto market outlook, yes, but they also need to continuously assess the credit rating and financial health of the institution issuing the ETN. That's a significant operational difference compared to a spot ETF where, theoretically, the underlying asset is held segregated and protected from the issuer's potential failure.
Okay, that's a huge point. Now, beyond the specific product structure risk, there's the regulatory risk itself, isn't there? The regulator, the FCA, is still essentially running this program as maybe not quite a pilot, but certainly a controlled experiment limited to professionals. They gave the green light, yes, but they still hold the power to pull the plug pretty swiftly if market conditions deteriorate or if things go wrong, right?
Absolutely. That regulatory backlash risk, or maybe reversal risk, remains a constant background factor.
Yep.
The FCA has a well-documented history of imposing strict, sometimes sudden measures when they perceive significant consumer harm or market instability brewing.
They don't hesitate to act if needed.
Not usually, especially regarding retail protection. They absolutely could and likely would reimpose restrictions on these ETNs if, for instance, market volatility were to spike to extreme, sustained levels reminiscent of 2021, or perhaps more critically, if there was clear evidence of widespread market manipulation emerging within this new structure. Remember, the initial ban was driven by exactly those concerns, volatility and integrity.
So surveillance needs to be effective.
Right. While global market surveillance capabilities have certainly improved since 2021, the fragmented nature of crypto trading happening across countless different exchanges and venues globally, some regulated, some not, still presents inherent challenges to effectively tracking and preventing bad actors or manipulative schemes. The FCA is essentially running a high-stakes test using professional capital first. If that test fails due to poor governance by issuers, unforeseen market events, or manipulation, you can bet those regulatory gates will slam shut again very quickly.
Okay, one final risk area we need to touch on. We've talked about the anticipated massive institutional demand flowing into these products, potentially globally. We need to address the systemic counterparty risks associated with actually handling all that demand, particularly when it comes to the custody of the underlying assets that issuers need for hedging.
Yes, this is a really critical point and one that often gets overlooked in the excitement of positive headlines about adoption. It's about concentration risk.
Concentration of custody.
Exactly. As more and more institutional capital enters the crypto space via these regulated products, ETNs in the UK, ETFs in the US and Hong Kong, other structures elsewhere, there tends to be an increasing and potentially dangerous over-reliance on a very small, select number of massive centralized custody solutions.
Usually big banks or specialized crypto custodians.
Right. These are the large, trusted institutions, often the big traditional banks, building out digital asset capabilities, or established specialized digital asset trusts that are actually holding the underlying Bitcoin and Ethereum securely, often in cold storage, on behalf of the ETF issuers who need it for their hedging activities or direct backing.
Right.
The risk of concentrating potentially hundreds of billions of dollars worth of assets into just a handful of these major custody providers is immense. Think about it. If just one or two of these very large, systemically important custody providers were to suffer a massive security breach, a hack, or maybe a critical technical failure, or even a sudden unexpected solvency issue themselves,
The fallout could be catastrophic.
it could instantly trigger a significant systemic counterparty risk event across the entire regulated market structure. The sheer size of the institutional flows we're talking about, measured potentially in the tens or even hundreds of billions globally, means the failure of a single major custodian could cause devastating domino effects. It could impact all the ETN and ETF issuers who rely on them for asset security and hedging, potentially freezing massive amounts of capital, shattering investor confidence, and plunging the entire regulated crypto space into a sudden crisis. It's a single point of failure risk that grows as the market scales.
So if we try and connect all these critical dots, the ETN structure risk, the regulatory reversal risk, the custody concentration risk, the underlying tension here seems crystal clear. The UK is aggressively, almost desperately, seeking to regain fintech dominance, trying to align itself globally with the momentum in New York and Hong Kong.
That's the ambition.
But it has to constantly balance this massive competitive ambition against these inherent structural and market risks, specifically that counterparty credit risk and the systemic custody risk, which were the very reasons they imposed the protective ban back in 2021 in the first place. It really is a high-stakes balancing act for the future relevance of London as a global financial center. #Tag7. Conclusion and final thought.
So to try and synthesize the central theme, maybe the central conflict, of our deep dive today,
Yeah.
the UK's decision to lift its ban on Bitcoin and Ethereum ETNs for professionals was a major domino. But it's crucial to understand why it fell. This move seems driven less by any kind of grassroots decentralization ideals, and much more purely by massive institutional demand, urgent competitive necessity in a post-Brexit world, and the pragmatic need to simply align with rapidly evolving global regulatory trends set by the US and Asia. London is planting its flag back on the crypto map, even if that flag is firmly attached to a traditional debt note structure. We've established pretty clearly, I think, that this is largely a pragmatic reaction to the explosive success of the U.S. spot ETFs and Hong Kong's parallel funds. The goal is clear. Rapidly capture a share of that European institutional wealth that was previously sitting on the sidelines due to regulatory hurdles.
So the key takeaways for listeners.
Immediate potential for increased liquidity and demand for Bitcoin and Ethereum. A significant boost to institutional confidence and portfolio allocation potential. And looking ahead, the practical inevitability of future retail access, possibly within a surprisingly narrow 12 to 18-month window if all goes smoothly. But underpinning all of this is the fact that this isn't just a win for crypto. It represents a profound absorption of the asset class by traditional centralized finance. It almost demonstrates that perhaps the only way to scale digital assets to this multi-trillion-dollar level is by adopting these familiar centralized debt structures and submitting to heavy regulatory overhead.
Which brings us neatly to a really fascinating, maybe even philosophical point about the whole direction of the industry itself. It's something we often encourage you, our listener, to really chew on after these deep dives. We're seeing these traditional centralized institutions embrace crypto assets for their portfolios, which brings legitimacy and capital, yes. But it also pulls these assets deeper and deeper into the existing centralized financial structure, away from their cypherpunk roots, perhaps.
A definite tension there.
So here's the provocative closing thought we want to leave you with today, drawn from reflecting on the source material. Does this kind of institutional adoption ultimately help, or does it hurt the original ideal of decentralization that underpinned Bitcoin? Or maybe putting it more immediately as a question of pure global competition. Is the UK simply trying to compete head-to-head with the US and Hong Kong for the same pool of global crypto dominance? Or is it perhaps trying to carve out a slightly different, maybe more uniquely European path forward?
That's a great strategic question to keep in mind as you watch the next waves of financial headlines inevitably unfold around this space.
Definitely something to think about. Okay, that's a wrap on today's deep dive. The UK lifts its ban on Bitcoin ETNs, signaling another significant global wave of crypto acceptance. With major institutions like the FCA, global giants like BlackRock likely watching closely, and the London Stock Exchange now actively facilitating trade, this really could mark a brand new chapter for European crypto investors, starting with the professionals. Now, if you found this breakdown helpful, if you learned something today, please take a moment to smash that like button, hit subscribe if you haven't already, and definitely ring that notification bell. We just want to briefly explain that subscribing, commenting, and engaging with the deep dive like this really does help support the channel enormously. It boosts our visibility in the algorithm, helps new people discover the content, and fundamentally, it lets us keep creating this kind of quality, in-depth crypto content for you every week. Your engagement truly makes a difference. It helps Crypto Robot grow, and it keeps us motivated to deliver these top-tier crypto insights. Thanks so much for listening.